Welcome to Talk Tickers. Today we're looking at Lineage Cell Therapeutics. They just reported Q2 2025 results, and it's an interesting picture. Revenue way up, but the GAAP loss also way up.
Yeah, it's one of those reports where the headline numbers almost contradict each other, right? You see soaring revenue, then this bigger loss.
Exactly. So the question is, what did the market actually pay attention to, and why?
Well, that's what we're going to dig into today. We've gone through the call, the figures, the commentary.
Our mission, as always, is to cut through that noise and give you the critical insights. What's really moving the needle behind those numbers?
And spoiler alert, it seems like investors are largely looking past that GAAP loss. The focus really appears to be on, the clinical progress, the partnerships, the underlying science.
Okay, let's put some quick numbers on that. So Q2 revenue came in at $2.77 million.
Which is nearly double the $1.41 million from last year. A huge jump and way above what analysts were expecting. So top line looks great.
But then the GAAP EPS, earnings per share, showed a loss of 13 cents. That's compared to just a 3-cent loss last year, so quite a bit wider.
It is, but and this is the crucial part. You have to understand why. It was driven mainly by two really big non-cash charges.
And non-cash being the key phrase there.
Absolutely. First, a $14.8 million impairment charge. This was related to an old VAC platform technology they basically aren't moving forward with anymore.
Right, a legacy asset write-down.
Exactly. And second, a $12.7 million charge related to the fair value of some warrant liabilities. Again, an accounting adjustment, not operational cash burn.
So if you take those out, what does the adjusted picture look like?
Much better. On an adjusted basis, they actually beat expectations. EPS came in at -1 cent, whereas the consensus was looking for -2 cents.
Okay, that makes more sense. And their cash position?
Still solid. They ended the quarter with $42.3 million in cash and securities. Management says that gives them a runway into the first quarter of 2027.
So plenty of breathing room there.
Yeah, significant breathing room. And the market reaction kind of reflected this nuanced view. The stock was up just under 2% the next day. Not a huge jump, but certainly not panic over the GAAP loss.
Suggests investors did sort of see through those non-cash items.
I think so. They're focusing on the pipeline progress and the strategic moves.
Okay, let's dig deeper then. That 96% revenue growth year over year. Where did that actually come from?
A lot of it was collaboration revenue, primarily from their big partnership with Roche on the OpRegen program.
Ah, okay, the AMD program.
Exactly. And there was also some deferred revenue they recognize now that the collaboration around that old VAC platform was formally terminated. So it's mostly partnership money and tidying up past deals.
Got it. And on the spending side, operating expenses were up.
They were to $22.5 million. That's up about $15.2 million year over year. But again, the main driver there was that non-cash VOC platform impairment we talked about.
Stripping that out.
If you look at the core operational spending, R&D went up just a bit to $3.1 million. That's mostly for their preclinical work, which is what you want to see investment in the future pipeline.
Makes sense.
And G&A, general and administrative, also ticked up slightly to $4.6 million, mainly due to using more third-party services. So the total net loss was $30.5 million, but yeah, heavily influenced by those accounting charges.
Okay, moving beyond the P&L. Let's talk funding strategy. That runway into Q1 2027 is good, but what are they doing proactively?
Well, there's a really interesting potential catalyst tied to the Roche partnership. They could receive another $37 million in capital.
$37 million. How?
It triggers if Roche and Genentech publicly announce they're taking the OpRegen program into the next phase of trials. There are some conditions, like Lineage's share price needing to be above 91 cents and other standard things, but it's a big chunk of potential non-dilutive cash.
Built right into the existing deal structure. That's smart.
Very smart. And it shows Roche's potential commitment. But they're not just waiting on that. They're actively chasing other non-dilutive sources, too.
Like what?
Things like milestone payments from other existing deals, program grants. They applied for a CIRM CLIN2 grant back in June, expecting a decision maybe around November this year.
For being the California Stem Cell Agency.
That's the one. And they're also looking for new partnerships. The whole strategy is clearly about reducing how much they rely on the public equity markets, which, can be pretty brutal for biotech right now.
Makes sense. Diversify the funding sources.
Exactly. Focus on deals that help fund specific programs, create new assets that can attract partners, leverage their manufacturing, get grants. And they're doing this while keeping their R&D spend relatively tight around $30 million a year, which is actually lower than a lot of companies with similar pipelines. disciplined.
All right, let's shift to the science now, because that seems to be the real driver here. OpRegen, that's their program for dry AMD with geographic atrophy, partnered with Roche and Genentech. They reported 36-month data.
Yeah, and this data is pretty compelling. They highlighted durable benefits, both anatomically looking at the eye structure and functionally in terms of vision.
What were the specifics?
The CEO pointed out something really striking. In patients who got what they called wholesome coverage of OpRegen cells over their geographic atrophy lesion.
Meaning good coverage of the damaged area.
Right. Those patients gained, on average, 9 letters on the eye chart over 3 years. But here's the kicker. Their untreated eye, the control eye in the same patient, lost an average of 11 letters over that same period.
Wow. So a 20-letter difference between the treated and untreated eye.
A 20-letter difference in mean visual acuity. That's huge. And it's durable over 3 years. It really challenges the whole idea that GA is just inevitably progressive and irreversible.
That kind of data could be game-changing if it holds up in larger trials.
Potentially, yes. And it's not just Lineage seeing promise here. They pointed out that 3 other companies, including Astellas, a big player in regenerative medicine, are also reporting vision gains with similar RPE cell transplant approaches.
So there's some independent validation of the general concept.
Seems that way. It helps de-risk the whole therapeutic strategy, you could argue.
So what makes Lineage competitive in this space then?
They believe they have several advantages. 1, they're arguably furthest along in clinical development for this type of therapy. 2, the partnership with Roche Genentech is massive. Roche brings resources, expertise, and importantly, they kept OpRegen when they did a big pipeline cut last year.
That's a strong signal.
It really is. Plus, Roche got RMAT designation for OpRegen from the FDA, which can help speed things up, and they're adding trial sites. Lineage also has its own in-house GMP manufacturing, which is a big deal for cell therapy.
We'll come back to that manufacturing point.
Right. And they've learned a lot about optimizing the surgical delivery from their current trial. So it's a combination of clinical-led, strong partner, manufacturing control, and procedural know-how.
Okay, let's switch tracks from the eye to the spine. The OPC1 program for spinal cord injury. Big news there this quarter too, right?
Huge news. They dosed the first chronic SCI patient in their DOSED study. This is significant because most previous work focused on acute or very recent injuries. Chronic represents a much larger potential patient population.
And they use a new delivery system for this.
Yes, a new parenchymal delivery system. It's designed to be safer, allowing them to administer the cells over about 4 or 5 minutes without needing to stop the patient's breathing, which was a concern with older methods.
Okay, that sounds like a major improvement.
It is. And this new system is also compatible with a new immediate use formulation of OPC1 they're developing, which would make preparing the dose much simpler right before surgery.
So the DOSED study is testing this new device in chronic patients.
Primarily testing the safety and performance of the device, yes. But they'll also be looking for any early signals of efficacy in these chronic patients.
Enrolling chronic SCI patients must be tough, though.
It definitely presents challenges. But Lineage is working with groups like the Christopher and Dana Reeve Foundation, and they plan to open more trial sites, especially in California, potentially tying into that SIRARM grant funding.
How does enrollment work? Is it slow?
It's a staggered enrollment for safety. They dose one patient, wait about 30 days for a safety review by a monitoring board, and then they can enroll the next. So it's methodical. 4 patients in this initial cohort.
And what about the cells themselves? Any updates on manufacturing OPC1?
Yes, they've developed a new manufacturing process. It improves the scale, the purity, the overall control. They're finishing up comparability testing now, getting ready to submit that to the FDA.
Comparability meaning showing the cells from the new process are essentially the same as the old ones.
Exactly. The goal is to get FDA clearance to use cells made with this new improved process in the later open enrollment part of the DOSED trial.
And looking ahead, are they planning bigger trials for OPC1?
They are. They mentioned they're designing a larger trial already, focusing on collecting really specific, clinically meaningful endpoints. They emphasized, that even small gains in mobility can be absolutely life-changing for someone with an SCI.
A really important perspective. How long will they follow these patients?
The plan is at least 10 years for the DOSED study patients to track long-term effects, though the main safety endpoint is much shorter, typically 30 days post-treatment.
Okay. Impressive commitment there. Let's quickly touch on the hearing loss program, Resonance or AMP1.
Right. This is another example of their platform at work. They generated a whole new cell type for this and got it into preclinical testing within about a year. And with a pretty small investment, roughly $1 million.
And they just landed a partnership for that one, too.
They did just after the quarter ended. A 3-year research deal with William Demant Invest. Demant is a big name in hearing healthcare.
How much funding?
Up to $12 million. It's specifically for the IND-enabling work, all the preclinical stuff you need to do before you can ask the FDA to start human trials.
So another source of non-dilutive funding, validating a newer program.
Exactly. Fits perfectly with their strategy.
Which brings us back nicely to that manufacturing capability you mentioned earlier. This seems like a core asset for them.
It really is. They've got their own in-house GMP good manufacturing practice set up. They can produce 2 different allogeneic cell therapies right now, starting from their master cell banks.
That's in scale.
They mentioned capacity to support several million doses. Now, these are often single administration therapies, but still, that's industrial scale for cell therapy.
That sounds like a significant competitive advantage.
Absolutely. Having that capacity and control in-house, combined with their expertise in actually making the specific cell types they need, that directed differentiation is huge. It lets them build their pipeline, create new programs like ANP1, and attract partners who need that manufacturing piece. It's a way to build value without constantly going back to the equity markets. It's a real moat in this field.
Okay, let's tie this all together in the investor context. The market reaction was calm, slightly positive, despite that GAAP loss. It really does seem like investors are looking through the noise.
Yeah, I think the focus is squarely on the progress. That durable 36-month OpRegen data is a massive positive, especially with Roche backing it. And the validation from other companies working on RPE cells just adds confidence to the whole approach for GA.
And for OPC1, dosing that first chronic patient with the new device
Is a critical de-risking step, opening up the chronic population, improving manufacturing, making the formulation easier to use. These things could unlock enormous value if the therapy works. It shows the platform is robust.
and that manufacturing capacity we just talked about.
Yeah.
Several million doses.
That's a strategic pillar. Cost efficiency, supply chain control. It's incredibly valuable when many competitors rely on external manufacturing, which can be expensive and complex.
Plus the new Demant deal for the hearing loss program. More non-dilutive cash, more pipeline diversification.
Right. It all fits their narrative of building a capital-efficient, multi-program cell therapy company, less dependent on volatile markets.
You know, in this current biotech market, which has been choppy for smaller companies, look at the XPI index. It seems Lineage's stock is really driven by its own specific news flow, its data, its partnerships, rather than just broad market trends.
I'd agree with that. Program-specific execution seems key.
So what are the key things to watch for going forward? Second half of 25 into 26.
Definitely more updates on OpRegen from Roche Genentech, enrollment progress, and maybe initial data reads from the OPC1 DUSA-D study, preclinical milestones for ANP1 under the Demant collaboration, and of course, any updates from conference presentations, lots of potential catalysts.
Right. Let's move to our not financial advice segment. Investment committee, gather round. I've got a pitch for Lineage. It's a bit wild, but hear me out.
Okay, always interested in a wild pitch. Let's hear it.
Given how the market seems to be ignoring the GAAP noise and focusing on the non-dilutive strategy and partnerships, I'm calling this the strategic diversification arbitrage play.
Intriguing name. What's the core idea?
The core idea, picking up on what you said earlier, is that Lineage has built this powerful cell manufacturing and differentiation engine that the market isn't fully valuing yet.
Okay.
OpRegen with Roche is basically de-risked to a large extent, giving you exposure to the huge AMD market, almost like a free option. The Demant deal shows they can spin up new programs and get them funded externally. Their whole strategy is about creating new assets to attract funding.
Right, using the platform to generate new shots on goal.
Exactly. So the trade is go long Lineage, but pair it with a synthetic short on a basket of early-stage single-asset cell therapy companies, particularly those focused on niche areas without strong manufacturing.
Interesting. Explain the arbitrage logic there. Why that specific pairing?
Because Lineage's GMP capacity for millions of doses is a massive, almost hidden asset. Most small biotechs burn incredible cash just trying to get close to that kind of manufacturing capability. Lineage is essentially acting like a CDMO for its own pipeline, and potentially others, plus a venture creator.
A hidden CDMO and venture builder.
Okay.
The market, I argue, is valuing Lineage mainly on its current name programs, OpRegen, OPC1. It's not properly valuing the platform itself, the manufacturing, the differentiation tech, which can keep generating new funded programs relatively cheaply compared to a standalone startup. That's the value disconnect, the arbitrage opportunity.
And the short leg.
The short leg hedges against general biotech sector risk, but more specifically, it bets against the less capital-efficient single-asset companies that don't have Lineage's integrated platform. Those companies are more likely to face dilution or struggle with manufacturing hurdles.
So you're betting that as Lineage executes, maybe partners or spins out another program like the Demont deal, the market will start valuing the engine, not just the current products. Precisely. The market will start to recognize it's not just another biotech with a couple of clinical assets, but a potential cell therapy factory, a more robust, diversified, and capital-efficient model. It's a bet on the industrialization of cell therapy embodied in this one company.
That's a really thought-provoking way to look at it. Identifying that underlying platform value, which might be getting lost in the quarterly focus on individual program data.
It's seeing the factory, not just the widgets coming off the line.
Powerful analogy.
So to wrap up our deep dive today, Lineage delivered a strong revenue beat in Q2, driven by collaborations. Yes, the GAAP loss was wider, but largely due to non-cash charges the market seems to be looking past.
Right. The real story is the clinical and strategic progress. Durable 36-month OpRegen data continues to impress, challenging norms in GA treatment. And the OPC1 program took a major step forward, dosing the first chronic patient with a new, safer system and advancing manufacturing.
Plus, they have a solid cash runway, a clear strategy for non-dilutive funding reinforced by the new Resonance deal, and that powerful in-house manufacturing. It points to a, let's say, cautiously bullish outlook.
Cautiously bullish seems fair. Execution remains key, obviously.
Absolutely. So as you digest all this, here's a final thought to chew on. In this complex world of biotech, how much weight should we as observers or investors give to a company's underlying platform, its manufacturing, its core science engine, versus just its named clinical programs? Could the companies mastering the industrialization of these advanced therapies, like Lineage aims to do, unlock a different kind of long-term value?
That's the multi-billion-dollar question in this field, isn't it?
It might just be. Thanks for tuning in to Talk Tickers for this deep dive. We appreciate your time and hope this helps you look beyond the headlines. Join us next time for another analysis of the latest earnings calls.